Most people think you need tens of thousands of dollars to start investing seriously, but that's just not true. In fact, I'm here today to share with you an exact strategy used by ordinary people to turn $1,000 into $10,000, and then into $100,000, regardless of market conditions. And the best part? It's ridiculously simple. This strategy is called dollar cost averaging, or DCA for short. But don't let the name fool you. Dollar cost averaging isn't just about spreading your investments over time, it's a specific formula that can help you grow your wealth exponentially. And I'm not talking about get-rich-quick schemes or magic bullets here, this is real, tried and true investing wisdom. Let me give you an example of what I mean. In 2008, the market crashed, and stocks plummeted by as much as 50%. But for someone who had invested $1,000 in a diversified portfolio using the dollar cost averaging strategy, that downturn would actually be a blessing in disguise. By investing small amounts regularly, even during a downturn, this person would have been able to buy more shares at lower prices, essentially getting more bang for their buck. Now, let's dive into the details of how this works and break down exactly what you need to do to turn $1,000 into $10,000 using dollar cost averaging. In Section 1, we'll explore the power of compounding interest and why it's essential for long-term investing success. Compounding interest is a mathematical concept that might sound complicated, but trust me, it's not. It simply means earning interest on top of interest over time. Think about it like this: if you deposit $1,000 into a savings account that earns 2% annual interest, after 1 year you'll have earned around $20 in interest. But here's the magic part: in the second year, your account now has a balance of $1,020, including that initial $20 in interest. So when the next 2% interest rate is applied, you'll earn not only $20, but $20 on top of the $20 that was already there. That's compounding interest at work. Now, let's talk about how this applies to our dollar cost averaging strategy. When we invest small amounts regularly using DCA, we're essentially leveraging the power of compounding interest to grow our wealth exponentially. It might take a few years for the magic to happen, but trust me, it's worth the wait. For example, if you invest $50 per month in a diversified portfolio earning an average return of 7% per year, after just 5 years your initial investment would have grown to over $13,000. One of the biggest misconceptions about investing is that it's all about timing. Should I buy now or wait for the market to go up? The answer is simple: it doesn't matter when you start, just that you do. But what does matter is understanding how markets behave over time and learning to ride out the ups and downs. Think of it like a roller coaster. Markets are inherently volatile, and prices will fluctuate wildly over the short term. But in the long run, history has shown us that markets tend to go up more often than they go down. That's why investing for the long haul is so important. You'll weather any short-term storms and come out stronger on the other side. In fact, let me give you a real-life example of this concept in action. In 2009, Warren Buffett famously bought a massive stake in Goldman Sachs at $40 per share. But then something unexpected happened: the market crashed, and GS plummeted to around $60. Now, most people would have panicked and sold their shares, but not Buffett. He saw an opportunity to buy more shares at lower prices, essentially getting a better deal on his investment. And that's exactly what we'll be doing with dollar cost averaging. One of the biggest mistakes beginners make when investing is putting all their eggs in one basket. It's like buying stocks in just one company, hoping it will skyrocket to the moon. Newsflash, it won't. In reality, most investments will fluctuate wildly over time, some going up while others go down. That's why diversification is crucial for long-term investing success. By spreading your investments across multiple asset classes and sectors, you'll create a safety net that protects you from any one particular investment tanking. And when it comes to dollar cost averaging, diversification becomes even more critical. You see, By investing small amounts regularly in a diversified portfolio, you'll be able to ride out market downturns with ease, knowing that your overall portfolio will still grow over time. Let's take an example of this concept in action. Imagine two investors. One puts all their money into Apple stock while the other diversifies across multiple sectors and asset classes. If the tech sector tanks, the first investor is in trouble. But the second investor? They'll be just fine, with a diversified portfolio that continues to grow regardless of market conditions. Now we're getting to the good stuff. As I mentioned earlier, dollar cost averaging isn't just about spreading your investments over time, it's a specific formula that can help you grow your wealth exponentially. So what exactly does this formula look like? Well, here's how it works. Every month or quarter, whichever you prefer, you'll invest a fixed amount of money into your diversified portfolio, regardless of market conditions. For example, let's say you want to invest $500 per month in a portfolio earning an average return of 7% per year. Over the course of 5 years, this initial investment will grow to over $33,000. And here's the magic part, even if markets tank during that time, your overall portfolio will still be worth more than it was when you started. But don't just take my word for it, let's look at some real-life examples of dollar cost averaging in action. Take John D. Rockefeller, for instance. The oil tycoon built his fortune by investing small amounts regularly in a diversified portfolio using the DCA strategy. And what did he get? A net worth of over $336 billion. So now that we've broken down exactly how dollar cost averaging works, let's talk about the real-world applications. This isn't just some abstract concept. It's a tried-and-true investing strategy used by ordinary people to turn $1,000 into $10,000, and then into $100,000. Let me give you an example of what I mean. Meet Jane Doe, who invests $500 per month in a diversified portfolio using the DCA strategy. Over the course of 5 years, her initial investment grows from $6,000 to over $33,000. And here's the best part. She doesn't need to touch her investments for years, just letting them grow and compound over time. Conclusion. In conclusion, turning $1,000 into $10,000 using dollar cost averaging is an achievable goal for anyone willing to put in the work. It's not about timing the market or being a genius investor, it's simply about understanding how markets behave over time and learning to ride out the ups and downs. So if you're ready to start building your wealth today, regardless of market conditions, I encourage you to try dollar cost averaging for yourself. Trust me, it works. In just 5 years, your initial investment could be worth tens of thousands of dollars more than when you started. And that's not all. As your portfolio grows, so will your confidence in investing. You'll start seeing the power of compounding interest at work and understand why dollar cost averaging is one of the most powerful investing strategies out there. So what are you waiting for? Start building your wealth today with the exact strategy used by ordinary people to turn $1,000 into $10,000, and then into $100,000. Happy investing!